Friends, welcome to this session on leverage. Let's first understand the dictionary meaning of the word leverage, which is to use something to maximum advantage. It is thus a general term for any technique to multiply gains and losses. The power of leverage gives rewards beyond the amount of work or energy you put into a task. This was a generic definition. Today we are learning finance, so let's see in financial terms. Leverage is any technique that amplifies means multiplies, magnifies investor profits or losses. It is most commonly used to describe the use of borrowed money to magnify profit potential. That's why it's called financial leverage. But it can also describe the use of fixed assets or fixed costs to achieve the same goal, that is maximizing profits or losses. That case it's called operating leverage when you use fixed costs or assets. Mind you, any leverage has accompanied risks. Why? Because it comes with a commitment to pay principal and interest in case of a debt, in case of a loan, that is financial leverage, and a commitment to pay fixed costs in case of operating leverage. So if your volumes are high, low, sales are good or not, you have to pay those fixed costs. In other words, leverage is also called gearing. When a business has huge borrowings, it is called a highly geared business. Right? When the borrowings are low, it is called a low geared business. We should always have a balance. The business should neither be highly geared nor low geared. We'll look at an example of operating leverage. Say a company or a factory is capable of producing say 500 units, for which it has some fixed setup, fixed costs. Let's look at the base case in yellow, where the sales for a year is 300 units. I've taken lower numbers here. In real life, the numbers may be larger. Selling price per unit is rupees 50, so sales revenue is rupees 15,000. Variable cost is rupees 9,000 at 30 each. Contribution is rupees 6,000, and for this kind of a setup, as I told you, which can make 500 units, 5,000 rupees is a fixed cost. Therefore, contribution 6,000 minus your 5,000 fixed cost gives you an EBIT of rupees 1,000, earnings before interest and tax. Now let's look at case 1, which is a bit better than the base case, where 350 units are made and sold in a year. Selling price remains same at rupees 50. Sales revenue is rupees 17,500. Variable operating cost at rupees 30 each is 10,500. Contribution rupees 7,000. Fixed operating cost remaining the same at rupees 5,000. Therefore, EBIT is rupees 2,000, much more than your base case. We'll see the comparison. First, let's complete seeing the case 2, where sales is not good. It's lower than the base case at 250 units. Selling price remaining same at rupees 50. Sales revenue is 12,500. Variable cost at rupees 30 each is rupees 7,500. Contribution rupees 5,000, and fixed operating costs for this kind of a setup will remain the same in all three cases, mind you, at rupees 5,000. But contribution minus fixed cost, you can see that EBIT is nil, 0. So what do you learn from all these three cases? That is, in case 1, it's a favorable leverage. In case 2, it's an unfavorable leverage. Why? Because in case 1, 16.7% increase in sales leads to 100% increase in EBIT. Similarly, in case 2, it's the reverse. 16.7% decrease in sales leads to 100% decrease in EBIT. See the magnifying effect. Sales is dropping by what percentage and EBIT by what? Because leverage works in your favor in case 1 and against you, or against the company rather, in case 2, in a magnified way, not by the same percentage. 17%, 16.5%, 17% leads to 100% change in EBIT. That's the power of leverage. Maximize advantage or disadvantage. Both cases are true. So what have you leveraged in this case? Fixed operating costs have been leveraged, which work in your favor in case 1 and not in your favor in case 2. Let's look at another example. where we'll be looking at financial leverage. Let's start with the base case again, where we'll start with EBIT, earnings before interest and taxes, is rupees 10,000. Interest is rupees 2,000 for a given set of operations and borrowings, which can say make same volume of production. Earnings before interest and tax is 8,000. After paying tax, say at 25%, what remains for the ordinary shareholders is rupees 6,000. Assuming number of equity shares in this company is 1,000, earning per share is nothing but your earnings for your shareholders, that is earnings after tax, divided by the equity shares number. So it's rupees 6 per share, called EPS. Let's now look at a better case, that is case 1 again in this example, where your earnings have improved by 40% from rupees 10,000 to rupees 14,000. Interest remaining the same at rupees 2,000 for the same set of operations and borrowings, no new borrowings. Earnings before taxes is 12,000 rupees. Tax at 25% is 3,000 rupees. So earnings after tax for ordinary shareholders is rupees 9,000. Number of equity shares remaining 1,000. EPS is rupees 9. Magnifying effect again, we'll conclude soon. Come to case 2, where there's a drop in EBIT versus the base to rupees 6,000. Interest again remaining same for this set of operations and borrowings. EBT, earnings before tax, is 4,000. Tax at 25%. What remains for ordinary shareholders is rupees 3,000. Earning per share is rupees 3. So variation to base is plus 50 in case 1, minus 50% in case 2. Case 1 is a favorable leverage. Why? Because 40% increase in EBIT leads to a 50% increase in EPS. Case 2, 40% decrease in EBIT leads to 50% decrease in EPS. This shows you that leverage works in both directions, be it a financial leverage. In financial leverage, you have leverage interest cost. In operating, you leverage fixed operating cost. And in good times, it works in your favor because your fixed costs are affordable. In worse of times, it gets unaffordable. It works against you. Leverage works in a reverse direction in a lower scale volume. We look at a practical example. Two friends, Rohan and Mohan, both engineering graduates with little knowledge of finance, are starting identical businesses by themselves. Capital required for the business, the initial capital employed will be rupees 1 crore. For understanding this term capital employed, you can see this and various other terms. You can see my session on financial terms. For now, I can tell you this capital employed means the total investment required in the business. So total capital employed by Rohan, 1 crore, for which he takes a loan, that is debt of rupees 80 lakh, balance rupees 20 lakhs from his own funds, that is equity. Assuming rupees face value per share is rupees 10 per share, number of shares is 2 lakh in Rohan's business. So debt to equity, that is, which is also called gearing ratio or debt equity ratio, is 4:1, 4 times debt. While Mohan does not want to take debt, he's scared and he has enough money. So everything, whole 1 crore, he invests from his own funds, that is as equity. Assuming rupees 10 per share is the face value, number of shares is 10 lakh here in Mohan's case. Let's look at the profitability at the year end in case of Rohan. On the investment of rupees 1 crore, 15% is operating profit, which is 15 lakh rupees. But he has operating profit means profit before interest and tax. So interest on debt of 80 lakh at 9% say is 7 lakh 20,000, which you subtract. So earnings before tax, which is called EBT or profit before tax PBT, is rupees 7 lakh 80,000 in case of Rohan. I'm seeing everything pre-tax here. I don't want to confuse you all with taxation. In case of Mohan, the profitability, again identical businesses and similar profits, or same rather. EBIT, operating profit at the rate of 15% on 1 crore is rupees 15 lakh. Less interest is nil because there is no borrowings. So entire 15 lakh is EBT, earnings before tax. Great. So my question is, who is doing better? Any guesses? Let me ask you all again, which business is better? For which we need to see EPS. Let's look at the answer. From shareholders' point of view, if you have to see, because finally all the business is done for your owners, shareholders. EPS, which we are seeing pre-tax here for simplicity, is 7,80,000 EBT divided by number of shares, which is 2 lakh in case of Rohan. So that's rupees 3.90 EPS earning per share. Let's see in Mohan's case. EPS is rupees 1.50, that is 15 lakh divided by your 10 lakh shares. So now let me ask you again, who's doing better, Mohan or Rohan? Another way of looking at it is return on equity in percentage terms. So how do you do that? Your EBT, it will be actually after tax, but just now we are doing pre-tax, so earnings before tax, 7,80,000 divided by your 2 lakh shares gives you 20 lakh investment, sorry, not number of shares. This will be by your investment amount. 7,80,000 divided by 20 lakh multiply by 100 will give you 39%. What about Mohan's case? Return on equity is simple. 15 lakh divided by 1 crore. That comes to, you multiply by 100 is 15%. So what is the magic in case of Rohan? It is what Rohan has done on his investment of 20 lakh. Of course, he's earned 15%. So on this 20 lakh, first he's secured his 15%. Plus on the remaining 80 lakh, what he has done is, though he has paid the interest of 9%, his business has earned much more than 9%. That is operating profit of 15% on your investment. So 15 minus 9 is 6. 6% extra on that 80 lakh. Even after paying the bank interest, 6% remains. And that 6 is multiplied by 4. Where does the 4 come from? Your gearing ratio, because that 80 lakh is actually 4 times of your equity. So he's done this multiplying effect 4 times of this benefit of 6%, 4 times. That's 24% plus your base of 15% on his original 20 lakh. So thus he's earned 15 plus 24, which is 39%. That doesn't mean I'm recommending a gearing ratio of 4:1. That's very high. Ideal, as the experts say, is 2:1 or 70%, 30% debt to equity ratio. Let's end this session with the definition of financial leverage, which is the firm's ability to use financing costs to magnify the returns to ordinary shareholders, which we have seen in the above example. Thank you all for a patient listening. Goodbye. Signing off.